Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to go over all the stocks I hold in my personal portfolio in my TFSA and RRSP accounts and provide you a summary of their valuation metrics at this point in time and their risk-reward profile. I think lots of investors only focus on reward aspect of investing in the stocks and they never pay attention to the risks. And that's why a lot of portfolios out there are getting absolutely destroyed in this bear market. Here I want to not only talk about the valuations and potential return on investments, but I also want to discuss the risks and potential downsides of each of these stocks and gives you a number on a scale of 1 to 10 for both potential upside and rewards and then potential downsides and risk for each company. This is something that I do personally once a month to assess my stocks and decide whether or not I want to add to positions or rebalance the portfolio. I think this is going to be a very fun video. Okay, let's jump right into this. I will start the video with my TFSA account. The first position in my Canadian side of this account is Aritzia. One fun fact about Aritzia performance is that while every other big YouTuber and hedge fund managers are busy talking about tech stocks as the next big growth engines, Aritzia single-handedly outperformed pretty much all of those tech stocks in the last 1 year, in the last 2 years, and even in the last 5 years. Here you can see Aritzia not only outperformed S&P 500 in the last 5 years, it also outperformed Amazon, Netflix, Microsoft, and Apple by a large margin. This amazing performance is not random, is not by luck. In the last few years, Aritzia posted amazing growth numbers quarter after quarter and year after year, and particularly in the last 2 years was able to post explosive growth numbers during a bear market and economic downturn. They designed popular products that attracted young women and teenage girls, able to attract these loyal fans and customers to their stores. Aritzia planned to continue to expand their business by opening almost 8 new boutiques every single year in United States and increase their e-commerce business revenue. I believe Aritzia is currently fairly valued, maybe even slightly overvalued. It is not definitely undervalued, but it is not also extremely overvalued here. In fact, I recently performed a new estimation based on discounted future earnings model, and the fair value of Aritzia stock for a 15% return year over year was around $49. Today, Aritzia share price is around $52, which means it is almost fairly valued. In terms of the risk-reward profile at this point, I think Aritzia is a high-risk, high-reward investment. On a scale of 1 to 10, I think the reward in investing with Aritzia is a 10, which means on the upside, the reward could be fantastic, could be great. Aritzia may be able to continue its explosive growth and expansion plans and continue to significantly outperform the market. In that case, it can be a 10 bagger in the next 10 to 15 years. It means the stock price can be 10x in the next 10 years. On a scale of 1 to 10, I think the risk of investment in Aritzia is also an 8. It is a risky investment, but it is not crazy risky. There is a risk of a slowdown in their expansion plans and in the popularity of their products between teenage girls. If Aritzia is not able to continue to post these amazing growth numbers quarter after quarter, the stock price will be declined as the market expectations is very high for Aritzia. That's why I consider Aritzia a high-risk, high-reward stock. I'm not going to add to Aritzia here, but if the share price drops another 15 to 20%, I will absolutely add to my position again. The next company in my TFSA is Brookfield Asset Management. This is the company that Mohnish Pabrai is also bought in the last quarter. I believe Brookfield is undervalued at this point. My discounted cash flow model estimates the fair value of Brookfield to be around $75 for a 10% return year over year, and the current share price is around $60. They have a large amount of cash available to deploy into buying new assets and new businesses. And they plan to continue to grow their business by 20 to 25% year over year in the next 5 years. In terms of the risk-reward profile, I believe Brookfield is a low-risk, high-reward investment, which is ideal. On a scale of 1 to 10, I think the reward of investing in Brookfield is an 8. If everything goes well, you can experience a significant growth in the underlying businesses and can expect around 20% return year over year on your money. On a scale of 1 to 10, I think the risk of investment in Brookfield is a 3. It is a low-risk investment as the business itself is so diversified that it's similar to an ETF. However, they still invest heavily into different asset classes like real estate, which are really sensitive to interest rate environment and economic conditions. And that's why there is still some risks with investment in Brookfield. I will probably hold my Brookfield position as is until the spin-off of the asset management business, which will happen on December 10, and then reassess to see if I want to add to my position or not. Next company in my TFSA is Bank of Nova Scotia. I believe Bank of Nova Scotia is slightly undervalued here. My stock analysis is based on discounted future earnings model, estimate the fair value of Bank of Nova Scotia to be around $79, and it is currently trades close to $70 per share. I consider Bank of Nova Scotia to be a low-risk, mid-reward investment. This is one of my defensive positions which has extremely low risk on the downside. Canadian banks have strong regulations and are really conservative with their balance sheet, and they are one of the safest investments you can ever make. Bank of Nova Scotia particularly is beaten up more than the other Canadian banks in the recent market pullback, and as such I consider it extremely low risk investment. On a scale of 1 to 10, the risk of investment in Bank of Nova Scotia is 1. In my opinion, it is definitely minimal. In terms of the upside and reward, I think Bank of Nova Scotia is a 5. You can't expect explosive growth and returns from Bank of Nova Scotia like a company like Aritzia, but you can expect consistent growth, dividend increases in the coming years, so an almost 10% return year over year can be a reasonable expectation from Bank of Nova Scotia. I want to continue to buy Bank of Nova Scotia here as the valuations are really attractive for me. Next company in my TFSA is EQ Bank. EQ Bank is a small cap online bank and a competitor for conventional big banks in Canada. In my opinion, EQ Bank has one of the best risk reward profiles and one of the best valuations in the Canadian market at the moment. It is, in my opinion, extremely undervalued. They recently released their earnings report, which was really strong with lots of growth in their balance sheet and in their investments, and particularly in their net interest margin, which shows profitability of their business is on the rise. My recent estimation of the fair value for 10% return year over year was around $70 per share for EQ Bank, and the current share price is around $56. I believe EQ Bank is a low-risk, high-reward investment where on a scale of 1 to 10, its potential reward is a 10, as I believe the company can grow exponentially and return to value to shareholders quarter after quarter and year after year if everything goes according to their plans. This is one of those investments that can be a 10-bagger in the next 10 to 15 years. In terms of the risks, I think EQ Bank is a 3 out of 10. It is low-risk investment due to their strong balance sheet and their growing net interest margins, but it is still riskier than an established bank like Bank of Nova Scotia. If we have a huge problem with mortgages in Canada, EQ Bank might be in trouble, while Bank of Nova Scotia can probably weather the storm without any problem due to their larger banking operations, reserves, and also more business leverage. I will continue to buy EQ Bank here as it is extremely undervalued and has a very attractive risk-reward profile. Next company in my TFSA is Granite, which is an industrial real estate investment trust with many large warehouses around Canada, US, and Europe. They recently released their earnings report and increased their monthly distributions again. I think Granite is slightly undervalued here. The Granite fair value based on discounted future funds from operation model is estimated to be around $90 according to my calculations, and the current share price is around $79. I think Granite is a mid-risk, high-reward investment. On a scale of 1 to 10, I think the potential rewards with Granite is a 7. They are growing relatively fast even when the e-commerce businesses around the world is slowing down, which is a major plus in my opinion. If the e-commerce businesses start to pick up again in 2023 and 2024, I think Granite can experience even more increase in their profits and funds from operation. It's not going to be a 10-bagger like Aritzia or EQ Bank, but it can return 12 to 20% year-over-year return if everything goes according to their plans. However, it is not a low-risk investment for sure. I think the risk of investment in Granite is a 4 out of 10. If the overall economy slows down even further and we go through a recession, or if the Europe economy collapses due to energy crisis, Granite business will be hurt and the share price can go down in the short term. I will add to my Granite here as I think the valuation is still attractive. The next company in my TFSA is Killam Apartment Real Estate Investment Trust, which is a residential REIT with major exposure to Atlantic Canada, particularly Halifax, where the price of land and real estate increased exponentially compared to other parts of Canada in the last year, even compared to Toronto and Vancouver. I believe Killam stock is undervalued. My fair value estimate based on discounted future funds from operation is around $20 per share for Killam, while the current share price is around 16.5. I believe Killam is a low-risk, mid-reward investment. This is a very safe REIT as their net asset value or NAV is significantly below their market cap, and the gap between NAV and market cap is increasing even during this real estate market cool-off. Their buildings are relatively new. They have lower maintenance costs compared to other apartment REITs in Canada, and they have a relatively low average interest rates on their debts, which are positives in terms of the risk. As such, I think the risk of investment in Killam Apartment REIT is a 2 out of 10. It is definitely a low-risk investment. However, the potential reward of investing in Killam is also a 6 out of 10 in my opinion. You will get close to the average market return or slightly over the average market return with Killam. Killam for me is another defensive position with limited upside but also limited downside. I would definitely want to add to Killam at these levels and at these valuation levels. Next company in my TFSA is Toronto Dominion Bank or TD. I think TD is slightly overvalued at the moment. It is not undervalued, but it is not super overvalued either. My fair value estimate based on discounted future earnings model for TD is around $82 per share, while the current share price is close to $90 per share. I believe TD, pretty much like Bank of Nova Scotia, is a low-risk, mid-reward investment. Banks have heavy regulations and they are conservative with their payout ratio and their balance sheet, so they are pretty safe investments during the bear markets. I think the risk of investment in TD is 1 out of 10. It is minimal. However, the potential reward is also somehow limited, and I think the reward of investment with TD is a 5 out of 10. You are looking for the average market return or a slightly better than average market return. TD is another defensive position in my portfolio to protect my portfolio during the down markets. I don't have any plan to buy more TD shares at this point in time. Next company that I own in my both TFSA and RRSP is Google. I believe Google or Alphabet is undervalued at the moment. My fair value estimate for Google based on discounted future earnings model is $125 per share, while the current share price is around only $97. I think Google is another low-risk, high-reward investment. On a scale of 1 to 10, I believe the upside potential reward with Google is an 8 out of 10. We are looking at huge market outperformance and in my opinion, a return close to 20% year over year if everything goes well for Google. Downside risk is also pretty limited in this case and at this price point, and I think the risk of investment in Google is a 2 out of 10. They have risks of regulations, the cost of the risky bets, and the cost of their employees, which can push the stock price down in the near future. But other than that, it is a pretty safe company to invest your money in. They have lots of revenue streams, including Google Search, YouTube, Google Cloud, Android, and their moonshot projects. They pretty much own the whole internet and all the data in the internet search, which can be monetized even further in the future. This is an excellent business model with a huge moat and therefore extremely low risk of losing market share in the long term, in my opinion. I will continue to add to Google at this price range. The last company in my portfolio in my RRSP is Meta Platforms. Yeah, this is definitely my worst performing stock with a very disappointing performance so far. I believe, however, Meta is extremely undervalued here. I agree that Meta is burning huge amount of cash on Metaverse project. I agree that they overhired software engineers and employees that now basically they are forced to let go of. I understand that people hate Mark Zuckerberg and Facebook as a social media app, but Mark Zuckerberg is one of the best entrepreneurs in the world, and Meta owns Instagram and WhatsApp, which I believe are amazing social media platforms, which almost half of the world population use these platforms every single day. I also love their VR headsets, Oculus products, even though I think they invest too much money into this Metaverse project at this stage. According to my discounted future earnings model, the fair value of Meta stock is around $230 and the current share price is only $110. It is definitely undervalued here by any metrics that you can look at. I believe Meta is a mid-risk, high-reward investment. The reward is definitely a 10 out of 10. If Metaverse is a success, or if Meta cut the Metaverse budget slightly, I believe Meta stock can be an easy multi-bagger in the next 10 years. There is, however, some downside risk with Meta as well. If Meta continue to burn cash on Metaverse project, and there is no success in this project in the next 5 years, I believe the risk of investment would be high. So the risk of investment in Meta is a 4 out of 10. I will continue to buy Meta here as I believe it is extremely undervalued. There you are, guys. I hope you enjoyed the video and my transparency in showing you all the positions I have in my own portfolio and also the performance of my stocks. If you enjoyed the video, consider subscribing to the channel to see similar videos. Thank you for watching, and I see you guys in the next video. Farewell.